and welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook, and I'm going to be your host here for about the next 30 minutes here on Options Guide TV. Well, big day today. The market basically, I guess the biggest news is all about inflation. We saw the CPI come out with decent numbers that make the Fed's 2% level seem like it is in range, and also brings up the fact that maybe as we go into the end of the year, we might be able to cut a few more times as far as, and by we, I mean the Fed. So the market has taken that as a positive. It needed some positive news. We're a little bit more worried about the inflation front, especially what has been happening in the 10-year and the 5-year in the bond market as far as yields are concerned, as both of those benchmark treasuries are pushing their way towards the 5% level, indicating that the market is a little bit worried about what could go on with inflation. And it was really driving had a stranglehold on the markets. We saw it in the VIX index running up to the 1920 level. And that has also backed off today, and mainly because of the strong bullish move or a decent bullish move that we have in the marketplace. Banks earnings, which I've been befuddled by the fact that the banks have struggled so much in this environment. When the Fed started lowering rates, you anticipated that the financials are one of the sectors that is fairly valued. I was going to say undervalued, but I'll say fairly valued relative to the rest of the S&P 500 index. And we've had a good start in the banking sector as far as JP Morgan started off with earnings, and now Goldman Sachs. And we had a trade on in Goldman Sachs, which the earnings report saved us in that trade, mainly because, like I said, the financials have been beaten up. And I do think there's some opportunity inside the financial sector to either get long if you want to via the XLF, if you want to make it simple, or I did mention this when we talked about Goldman Sachs, just a lot of the deal makers like JP Morgan and Goldman Sachs, those are the ones that I wouldn't mind focusing on, with the anticipation that regulation may ease and there may be a few more investment banking deals that can be done. All right, so with that said, let me jump out of here and jump into the Tradier Pro software. All right, so we'll start with the Goldman Sachs trade. We looked at Goldman Sachs, and I'm going to pull this back just a little bit more. At the very beginning of the year, the stock was somewhere right in this range, right after the New Year's holiday, and we did a diagonal spread that was anticipating their earnings date. And now you've seen the market has actually, after the announced earnings, the stock is up about 5% today, actually even higher now. It's trading at 602.80. We were a little bit in trouble with this trade. I think we did the trade somewhere right around here when the trade was entered. And the stock obviously came down, but our hedge worked in that we sold a shorter term option against a longer term option, did it as a diagonal trade. And let me now zoom in on this whole little section here. And so at this point in time, our long option was hurting. So we go all the way back to January, right about here, when the trade was entered. 580 is where we were looking on Goldman Sachs. Market came down, got really scary right here. The option contract for our short-term option contract expired worthless, which was a good thing because we had sold it. Came here, and now we're right back to here. 5% move, which is, feasible as far as Goldman Sachs. But at that point in time, we just had a chip in a chair, if you will, and that our long option contract was not looking good. And now we are profitable on the trade. So if you're doing a calendar trade, and I guess let me go in and set it up and look at this. I always like this opportunity because if you are dead wrong and you're doing it around earnings, the earnings can save you. So let me spend a little bit of time on the Goldman Sachs trade, and I guess playing the hope game, which is not always good to do in option trading, but we managed our risk by getting into the trade the way that we did. Okay, so with that said, I'm always trying to find a way to use the strategies inside the options playbook to where if there are at least 2 or 3 different scenarios that will work out, and then there's one that will hurt you. Okay. And we have that same scenario going on in the SPX, and that trade is looking really good also. And then we put a VIX trade together not that long ago when the VIX was trading at 19, anticipating that after the inauguration that we could have a little bit more, the markets maybe settled down a little bit. And the VIX was up around 19. So we're going to look at all those trades. So let's start with the Goldman Sachs trade today. All right. So in Goldman Sachs, back at the beginning of the new year, we looked at buying the 595 strike call and selling the 600. We were a little bit out of the money when we did the trade, paid $7.60 for it. So we bought pumped up implied volatility because it was around the earnings date. And it actually wasn't official when we put it in. The earnings date ended up being on the 15th, which is today, right? Yep. Just make sure that it was the 15th. And then I bought the 24th expiration, which I don't mind doing that at all. You're still buying the pumped up vol. You still think that implied volatility could go higher as you head into earnings. Now, sold the 600 strike call, and that was a shorter term call, and that expired last week, I guess, is when it expired. I'm not even really sure what expiration that I had on it. But the stock was moving away from us. So here's the expiration date that we had. We had the 10th. So it was 14 days ago that expired. Now, that was the 600 strike. There was not even close to, right? So if we look at this, we weren't even close on the 10th. We're right around here. Right there at 576, and we had the 600 strike. So we weren't even close to it at that point in time. Now, if we come back and we look at the trade, now we're at 600. Market's at 601.84. So it bounced off a little bit. It's all over the place. And we are now trading for $7.60 on the trade. We were just a second ago trading higher at around $8. So here we go. This is the one that I wanted. That's the one that I want. We want to get rid of this one. Here's the one. And let's sell that. Okay, 595. So at this point in time, we could sell it for a double, $13.88. We put it on for $7.16. Not quite a double. We need to get up to 15. The market's doing strong. It was just up at 602. I would definitely put in a trade today to get out of this. You do have more earnings that are coming with the banks, and you're not quite sure. Well, we have the inauguration that's going to be happening on the 20th. So with that said, I would look to get out of this trade today. I feel like you got lucky on the trade. The market went up. We could sell our long option contract now for around $13. If you want to, you can try, because it was just at 14. The market was at 603. And if you look at the chart, let's go in here and look at this. Yeah, we got as high as 609, but it was recently at 603. Was feasible. Not, man, we got all the way up to 609 on this. We could have probably sold that a little bit earlier today, but I would, if I could get this thing where I have a doubler on it, I'm definitely going to get out of the trade today, and I'm probably going to close it out before the close today, if you want to look at that. Okay, so now how did we set up this trade? So if you do long calendar trades, excuse me, let me just clear my throat here for a second. If you are setting up long calendar trades, and I am doing them around earnings, it can be a diagonal trade, it can be a calendar trade, where you buy the expiration that contains earnings with the anticipation that as expiration approaches, or as that expiration date approaches and that earnings date approaches, you're going to see implied volatility to continue to increase. And this is a great example of that, in that a lot of people look at a time spread or at a calendar spread and don't really realize that you are hoping for a movement up in implied volatility. Why? Because when it's all said and done, you are really just long an option contract. And that's what our position is. You want the short-term option to expire and go away, and you want the longer-term option contract to increase in implied volatility. And this is a great example of what happened with Goldman Sachs. Now, we put the trade on. The market, we bought the 595 just out of the money, and we sold the 600, saying that we would like the market to go to 600 prior to that expiration date on the 10th of January. That would ideally be the scenario that we wanted. Hold that up again. Okay. And that would be the ideal scenario that we would like in that trade, in that we don't want to take the risk of the earnings, but it is an option. So the market, if it runs up to 600 and we are long a back month option contract, that as the stock is moving up, that implied volatility could still be moving up. And we put the trade on for, let's say, in our instance, $7.60. And because of that move from around 587, 588 is where the market was at. Let me see. I can actually get more accurate. 580, 580, 585 in that instance. And if we can get the market to move up towards our short strike, and we can flip this trade for a few dollars and not have to deal with earnings, that in my mind is a home run on the trade. And that's ideal with any calendar spread that you're doing. Now, market went against us. As a matter of fact, we were down. Both our long option contract and our short option contract were looking ugly after the expiration of the January 10th option contract. But we still had an albatross out there, and that there was earnings. The expected move was about 5%, and the underlying stock has moved very close to 5%. It's actually 5% right now, 5.14, 31 points, and it's went in the right direction to the upside. Blew through our 595 strike, and now we're seeing it trading for 14. So I'd put a limit order in at 15 right now, 602.66. I would have a limit order in at 15, and that saved us. So here's our scenario. We put on the diagonal spread. We wanted the market to creep up, if you will, towards the 600 strike. We wanted to be able to sell our diagonal spread that we put on for $7.60 for somewhere around $9.60, maybe $10, maybe make a couple of bucks on the trade. That would have been ideal. That didn't happen. The market went completely the opposite way. And that has a lot to do with what happened with interest rates after Fed cuts, and the fact that both the 10-year and the 5-year started to approach that 5% level, worries about inflation. All of that was waned by the CPI report today. Okay. So what our scenario here was, we put it on, we have limited and known risk. The market went against us, and it could have announced earnings, and it could have just went away, and we could have lost our entire investment. We managed our risk. We lowered the risk a little bit by selling some premium against that, selling the shorter term option, and decided that, well, since that option contract will expire, let's just ride this into earnings. We have it at a little bit lower price, and let's hope that we get to move in the right direction after earnings. So it's a okay scenario, and I like to approach earnings reports, especially if I want to be bullish in the marketplace. And I've been in my own account, I have some financial stocks which have been hurting, and basically until just now, where we're seeing growth across the industry. Even the XLF is up 2% today, trading at 49.31. So it's up $1 or $2 or 2.15%. Okay, so that's the Goldman Sachs trade. If you have any questions on that, please do put them in the chat box, and I will be happy to try to address them during the show. All right, now let's get into the SPX trade, which we put on Monday. So, outlook on the market this week was neutral to bearish. We've been doing some SPX trades where we got a little bullish going into the Santa Claus rally, which the market usually rallies between the periods between Christmas and New Year's. This year it did not, and past performance is never a guarantee of future results. And instead of the market usually being up about 1.5%, it was down. So those trades weren't really working out, but we had a pretty good track record as far as the SPX is concerned in our weekly trades that we look to try to do here on the show. And once again, everything's not meant to be necessarily be a recommendation for you, but it is a way to learn how to apply a lot of the strategies that are in the options playbook. Okay. Then we looked at doing a few butterflies below the market, and a couple of those worked out, but they also recently haven't done as well. So my attitude this week was, let's do a more neutral trade. The marketplace is struggling to go higher. We could sell a call spread saying that we want the market to stay where it's at or go a little bit lower. Or we could do what's called a skip strike butterfly, which to me is an alternative to a short call spread, because you're doing a butterfly for a net credit to the account. And I've emphasized this many times. If you went back in great detail on Monday on how you set up the trade. You're looking to sell a short spread and taking that credit and paying for a standard butterfly where the wings are the same width. And we went over that a lot on Monday. So that trade that we set up is the 590 or 559.50, 59.60, and 59.80. And we did that for a net credit of 55 cents to the account. It's going to expire this Friday. And I did notice something, and this is an issue, and I should have brought it up on Monday, but there are two different SPX expirations on January 17th. You always want to make sure you're in the expiration that has the weekly. This is old school SPX. This is a European style option contract. And I have always complained to the CBOE that this is just very confusing for clients. They used to have an SPX AM and an SPX PM chain, and they got rid of it. And it's mainly for marketing power, because they want all these options to trade, and they're worried about liquidity. And if you type in SPX, that is obviously the most well-known symbol. But if you buy this one, the market reacts a lot differently, because these stop trading on Thursday and there is an AM settlement on Friday. So and it happens once a month, the third Friday in the month, and these are the weeklies. These expire on the actual Friday after the close. So very big that we stay in the SPXW. Okay. And I should have mentioned that on Monday. And so here we go. 59.50. Buy this one. Sell the 59.60. We're going to sell two of these. Sell two of those, then we skip the 59.80, which embeds the credit spread, basically, that pays for the butterfly. And we buy the 59.80. So we got to buy this one. So right now, we put this trade on for a net credit of 55 cents to the account. When we initially entered that trade, it was for a net credit of 55 cents to the account. As the market moves this direction and it lands somewhere, let's go and send this to the what if calculator. As expiration approaches, if we see the marketplace start drifting towards our middle strike here, we could put this on for a 55-cent net credit, and we could take it off for a actual net credit to exit the trade. So we're at 59.30. What we'd really like to happen is this start drifting towards the 59.50 level in this trade. And then if that does happen and we can land somewhere between 59.50 and 59.70, right within this range, we will be able to do this trade put it on for a net credit and have us take it off for a net credit. Now, if we had just done the short spread where we just sold the 59.70, so let's take this off and buy the 59.80. It would have brought in a net credit of about what was 65 cents, around 70 or 75 cents when we put on the trade. And if we were looking to close this trade right now, we'd have to pay a net debit of $3.10. So the market rally today would might even scare us out of this trade, because you put it on for a 70-cent net credit. And if the market blew through that, this is a 10-point wide trade. That's the maximum that you could lose. You would probably consider getting out of this trade right now. The fact that we have our butterfly in and we have 2 days remaining until that expiration date on the 17th, that means that if we can get the market to just settle down right here and slowly drift towards that 590 level, that we're going to have a decent chance at actually putting this on for a net credit and taking it off for a net credit. We're up 1.5% today, up 90 points. So interesting to see that happen. We also saw the VIX index come down below the 17 level. And lastly, so if you have any questions on that one, and there's a comment, okay. Anthony, you're saying that's the Monday trade? Here's the record that I have, Anthony. $117 expiration. 590, 560, 580. Or 550, 559, 50, 59, 60, 59, 80. Market was at 58.01. Yeah, that looks right. 117. Well, so that's the numbers that I got. All right. So if we're on that trade, then we've moved too much against it. So Anthony, if the market is trading at 59.40, you would have to get out of that trade right now. Because if we're at 59.40, it rose too fast against the position. So here we have 59.40. We're up 90 points, 1.52%. 59.30. by 59.40. We would sell that twice and skip and hit the 59.60. Okay. Yeah. So if we're here, if it hits 59.40, you want to get out, because now that's a net credit of $40. So if you flip the script, you got to pay $4 to get out. You put it on for 55 cents. Your max risk is 10 points on the trade from 59.50 to 59.60. If those are the expirations that we ended up doing, we moved it all the way down to 55.30. Huh. Man, that's a big move over that time period. Then you would want to get out of the trade right now. Monday was the 13th. Yeah, we had a fairly volatile day on that day, didn't we? Did we not? Yeah. So on the 13th, we went from 58.80 all the way up to 58.35. That's the high end and the low end of the trade. 58.80, 57.80, all the way up to 58.31. So we're saying the market was right around 5,800 at the time. All right. All right. Well, if that's the case, Anthony, then in this situation, I wouldn't mess around with it. If we're trading at $4 net credit to the account, you'd be down 45 cents on it. 57.93. Okay. And yeah, 57.93 when the trade was put on. And if you wanted to do this though, Anthony, if you want to approach this, then if the market, if we ever do put a skip strike on, there is an alternative to this adjustment, but the market has gone against it. I wouldn't do it. I would get out of the trade because we're too close to the 59.40 level. Now, obviously, 1 day's worth of time decay is huge, because this is where you'd want the market to end on Friday. If you had this trade on, you'd want the market to end right here, and that would be ideal, 59.35. But there's too many days and too much risk from 59.90 to 59.60. So this is a very tough trade now if the market is at that level. If we're looking at the initial strikes, which I'm going to have to go back and re-look at the show. If we look at the initial strikes that were done with the 59.50, well, we're not even to that level yet. So you're feeling pretty good about the trade. You're going to be down on it until the end of the day, as long as the market stays below 59.50. Time decay is going to be huge in the option contract. But right now, if you're sitting here and this is trading for a net credit of $4, this is a very risky scenario, and I would have been out of the trade. Well, I'd be out of the trade. Let's put it this way. If the market hits 59.40, which is our short strike, and it hits it today, then we get risk from 59.45, 59.50, 59.55, all the way down to 59.60. So if that happens and I hit this strike, which is a very high probability of happening right at this point in time with the way the markets are moving, I would get out. And that would be my stop point right there. I don't want to let it blow through the 59.40 strike. Today is a big day of time decay in SPX options. When you go from Wednesday to Thursday, that is a large rate of time decay because of the value of the index. SPX, another way to say that is the SPX holds its value very tightly until we get much closer to the expiration date. So on Monday, there's still a chance, like the premium protects you. The market moved against you, it would actually help you out and protect you. Now that we're on Wednesday, we're right on that precipice where the implied volatility is protecting you a little bit, or I should say the value and the time premium that is in the option contract is protecting you a little bit at this point in time. But if we do blow through the 59.40 strike, I would want to get out. And that's where my plan would be. And Anthony basically will show that one. Yeah, it's a tough spot right now. So, but have a hard stop. Stick to your plan. Have a plan and stick to it. The market's already moved back down to 59.25. And interesting enough to see that the VIX is down, which is helping us on this trade. If you put this trade on and implied volatility, and you're landing somewhere within your strikes, the implied volatility you want to come down, because ideally what you need is this $24.90 option. Let's call it a $25 option. You need these options to expire worthless, and you need as much time premium to come out of it. It can be because of time decay, and it can be because implied volatility comes off. So this is the range right here, and the trade is looking decent now. We've already moved 40 cents on the way down. So hard stop at 59.40 today. If we can stay below that, then this trade gets much more interesting tomorrow. And then if you stay below the 59.30 level tomorrow, then it gets real interesting on Friday. And you could potentially, in that scenario, if you can manage to stay out of the trade, we don't hit the 59.40 level, we don't get out, we don't manage our risk by doing it, this trade could end up being a home run. I like the other trade way better, obviously. I liked this 59.50. 59.60, skip the 70 and buy the 59.80. Yeah, that trade I think would look really good at this point in time, especially after a big move up in the marketplace, and you got a couple of days for the market to settle in and trade. But we do have earnings, not as much major news coming out. I mean, I guess the Fed can speak at any point in time, and there's always economic data, but the CPI was the big report. And this is the move off of the CPI data. All right. Monday is the inauguration, and everything becomes real. We're going to start getting more and more news. And this is one of the reasons why we looked at an IWM trade. And I do have the IWM trade on in my personal account. And right now, the market is up $3.72. We put it actually, so this is doing quite well. We went out to the February expiration. We did the 217 strike, and we did it for $11.80. And I'm hoping I got that one right. I think I do. So the expiration that we looked at is going out to February. Let me double check my screenshot again. Seventh expiration, we looked at buying the 217 strike call. Let's clear this out. And buying the 230 strike call. All right, 11.47. So we're still down a little bit on the trade. We put it on for 80 cents. Implied volatility came off. It's down around 22%. So right now, volatility has really been messing with the trade. But here's the number that I really care about. So if we're long the call option right now, and we can sell that for $9.26. The goal here would be to be able to sell this for north of $12. Paid $11.80 for the trade. If we can sell this for $13, get a few bucks on this side of the trade, especially this early in the trade, and kind of hope for the whiplash and also be profitable on the put side of things. Because right now we're in the range where we still have we have a 72 delta on the call. Every single point move, we're making 72 cents or $72 on our long call option. And on our long put option, we have a put delta that's 30 cents. So net, we're going up 40 cents on this trade if the market continues on up. So we need the market to continue on up. We need this delta to go down, ideally. Means you're losing value on the put and this delta to increase. What you really want when you do a long straddle is one of the option contracts to get a delta close to 1, so that offsets the loss that you're getting on the put side of things. So my focus here is on the $9.26 of the 2017 option contract. And the implied volatility, we do want to increase if possible. Now, the downside, obviously, you had a higher chance of implied volatility increasing. Right now, when we put this on, I think the vol was right around 24% implied volatility. Actually, I have it in here. Yeah, 24.72 is the vol that we paid for it. Now we see the vol coming off, and that does hurt us on the trade like this. So the fact that the market is going up, it's harder to make it more profitable than if the market's going down and implied volatility is going up. But we'll take it. We're at this range right now. We're up 370, up 1.67%. Hope the momentum continues to the upside, and we can push this north of the $12 range. And at any point in time, it's okay to leg out of the long call side of things. Try to lock in a few dollar profit, and then allow, hopefully, the whiplash to occur, and you can actually get profitable on the put side of things. And that's the plan with IWM. More time, the merrier. We're 23 days away. If we get down to 10 days, we'll think about just getting out of the trade, trying to salvage what we can from the trade. And that's it. And Anthony, I don't think I did anything wrong on that one, right? Yeah. You probably didn't do the IWM trade. Here's my attitude on long straddles. I don't like doing them just willy-nilly. Very rarely, maybe I'll do 4 or 5 long straddles a year. And it's all based off of not earnings, not known news events. I think the Russell 2000 is a very speculative index at this point. It always has been. You're talking about small caps. But as we get into the new administration, there's going to be a lot of issues that could happen. We see with the bond yields going up as the Fed's cutting, new policies that are coming out, tariffs. A lot of that can affect the small caps. So I'd like to go out as far in time as possible. As a matter of fact, I went out to the 14th in my own personal account. And as news hits, the IWM is going to be very volatile. And if you look at the chart, it's really trying to decide which direction it wants to go. So I don't mind doing this trade now. You would just move everything up. We actually came down to the 200-day moving average and bounced. So a lot of chop right now. Let's go. So here's the 200-day. Let's zoom out a little bit. We were right in the middle here when this happened, came all the way down, it's gone all the way back up. And now what we'd really like to see happen is break above the 225 level. All right, so if we get above the 225 level, this gap that came all the way down to this level might fill, and that would be an ideal scenario. Also right here, we had a gap to the upside. So then you're looking at another 15-point potential, and look at how short of a time period that we did that. Okay, and before, and I mentioned on the day that we did the show, mentioned this channel in IWM and how that we were buying straddles on the top of it, and on the lower end of it, we did a few of those trades. This wouldn't have been a bad place to do it, but it wasn't as established of a channel as this one is. Let's go back a few more days. Let's do 1400 days. Like, look at the time period that this this range went from 2022 04.29 is basically one of the first time we came all the way down to 23.11. And I think we bought one down here and bought one long straddle there. And then eventually it broke away to the upside. Kind of, this was choppy. This is just noise to me. I wouldn't want to be doing anything in this range. And here we have the same type of noise, had to break out, but we also have the changing of the guard and policies. And I think that these news events about tariffs, about interest rates, about the Fed cutting or not cutting, about the 10-year yield pushing up against the 5% level, now backing off a little bit. All of these things are greatly going to affect the Russell 2000 index and the small caps. And hopefully we'll get some break to the downside. I was kind of hoping when we hit this level that we might break through that 200-day, because we almost touched it here. We almost touched it there. We did touch it there. We almost touched it here. But it has a little bit of support in the IWM. All right. Nice, Anthony. All right, we'll leave those comments there. Any other comments or questions that we have? So we had a big show. Oh gosh, we're way long today. I apologize about the tangent on the SPX. So this trade will play out, and I still don't mind the trade because I think the big event is the inauguration and the changing of the guard. And I think there will be, mentions about it won't take an act of Congress in order to change tariffs. It won't take an act of Congress to see action in the interest rate marketplace and the bonds and the anticipation of new policies. So all of that, I expect this volatility to increase a lot in the IWM. And that's that simple. And that's when I want to do a long straddle. Other times when I looked at long straddles, Boeing, when they were trying to determine are the planes going to fly again? Unfortunately, the accidents that they had with the planes crashing and the grounding of the planes, there was news headlines that were hitting all the time that were blindsiding the stock. And the stock was reacting either positive or negative to those headlines. So that is a stock that was interesting. I go all the way back to ExxonMobil when they're trying to cap the well. These are things where you don't know what type of news is going to hit. And that's the only time I like to do long straddles. IWM is just I've always felt like the volatility in the IWM, you get a decent valuation as far as vol is concerned. We're actually the IV ranking is we're on the lower end of the range based off of the historical and where the IWM is at. So that's it. That's it for today's Options Guy TV. We're going to come back on Friday. It's going to be an interesting day on Friday. We're going to remain long this IWM trade, and I hope the best with Anthony on the adjustment on his trade in the SPX that we put together on Monday. I feel bad that I adjusted the trade to the downside, and hopefully it'll all work out. Let's see where the SPX ended up today. Well, we close out the session. 59.50. All right, we're down a little bit on the SPX. We just needed to hang here for a couple of days, Anthony. All right, thanks for stopping in. We'll see you this Friday at 11 a.m. Eastern time for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.